What if you nailed every technical question, then failed one simple X-date scenario and lost the offer? Corporate actions interviews are designed to test precision under pressure, because one bad entitlement can move real money. I'm from this channel, and today we're breaking this down simply. By the end of this video, you'll know how to classify events, how X-date logic drives entitlements, and how elections work end to end. Interviewers aren't asking for definitions. They're testing whether you can protect entitlements and cash flows. A corporate action is any issuer event that changes a security's cash, shares, or terms. Think dividends, splits, rights, tenders, mergers. The key is operational impact: positions, record dates, pay dates, and instructions. For example, on a 10,000 share position, a 50-cent cash dividend is a $5,000 entitlement, unless you mishandle the date logic and assign it to the wrong holder. To put this in perspective, one wrong entitlement on a $50 million custody book can trigger client claims, breaks, and regulatory scrutiny. Mandatory means the event happens automatically if you hold the security, no choice. Voluntary means the holder must elect an option. Some actions are mandatory with choice, where the event is mandatory but you can choose the form of proceeds. For example, a 2-for-1 stock split is mandatory. 1,000 shares become 2,000 shares automatically. A tender offer is voluntary. You must submit instructions to tender, say 500 of 1,000 shares at $25. Interviewers often ask you to categorize quickly because the workflow is totally different. Mandatory focuses on entitlement calculation. Voluntary focuses on election capture, deadlines, and allocation. And here's the part most people completely ignore. Record date alone doesn't tell you who gets paid. You must understand X-date mechanics. Record date is who the issuer looks at. X-date is when the security starts trading without the entitlement. Pay date is when cash or shares actually move. For example, if X-date is March 10th and you buy on March 10th, you typically do not get the dividend. You needed to buy before X-date. To put this in perspective, a $1.20 dividend on 20,000 shares is $24,000. Date mistakes aren't small ops issues. They're real money. X-date logic answers one question: does the buyer or seller receive the entitlement? In most standard setups, if you sell on or after X-date, you keep the entitlement. If you sell before X-date, the buyer gets it. For example, you hold 5,000 shares and sell them on X-date morning. Even though settlement happens later, the trade is typically X, so you still receive the dividend. Interviewers love a comparison. Trade date drives entitlement in many markets. Settlement date drives ownership in others. So you must confirm market convention. A good answer: I'll validate local market rules, but generally X-date determines entitlement transfer. Mandatory events test your ability to compute new positions and cash. Cash dividends are straightforward. Shares rate. Stock dividends and splits require adjusting quantity and cost basis. For example, a 3-for-2 split. 1,200 shares become 1,800 shares. 1,200 times 1.5. Mergers can create multi-line entitlements. You might receive $10 cash plus 0.25 shares of the acquirer per old share. To put this in perspective, if you own 40,000 shares, 0.25 shares per share creates 10,000 new shares. If you misapply the ratio, your reconciliation breaks immediately. Interview-ready phrasing: mandatory equals entitlement calculation and lifecycle booking. Now here's what nobody tells you about corporate actions interview Q&A. Mandatory versus voluntary events. X-date logic. Elections. Voluntary actions aren't about knowing options. They're about controlling deadlines and instruction risk. You need to capture elections, validate holdings, apply oversubscription logic, and manage cutoffs. For example, a tender offer at $30 when the market is $28 invites participation. But if you submit after the agent deadline, the client gets nothing. Rights issues are classic. You may receive 1 right per share, and 5 rights let you buy 1 new share at $20. If you have 10,000 rights, that's 2,000 new shares plus cash payment of $40,000. This category is where candidates stumble. The event will occur, but the form of proceeds can vary. For example, a dividend with options. Take $1 cash per share, or take stock equivalent to $1 at a reference price. If you don't elect, you get the default, often cash. On 15,000 shares, that's a $15,000 decision. Interviewers want you to say, "I'll confirm defaults, election deadlines, and whether there's a proration or discount on stock options." To put this in perspective, one client preferring stock for tax or reinvestment reasons is common, and the ops team must enforce elections precisely. Every voluntary event has options, default option, market deadline, client deadline, and internal cutoff. Internal cutoff is earlier because instructions must be validated and transmitted. For example, if the agent deadline is Friday 5 p.m., a custodian might set an internal cutoff Thursday 12 p.m. If a client sends Thursday 2 p.m., you may still reject it if your controls require 12 p.m. A clean interview answer includes controls. I validate eligible position, ensure no holds, blocks, capture election, confirm acknowledgement, and monitor for amendments. One late election on a 100,000 share tender can swing $200,000 in proceeds. In tenders and rights, you often face proration. If the issuer wants to buy back 1 million shares, but investors tender 2 million, acceptance may be 50%. For example, a client tenders 20,000 shares. Proration at 50% means only 10,000 accepted, 10,000 returned. Rights oversubscription works similarly. You may request 5,000 extra shares, but only receive 2,000 based on allocation. To put this in perspective, you must book pending correctly. Otherwise, you overstate expected cash. Interviewers want the keywords: proration factor, accepted versus unaccepted, return of shares, and final confirmation from agent. Entitlements aren't just about what you see in holdings. They depend on settled versus traded positions and whether you're long or short. For example, you may have 50,000 shares settled, plus a purchase of 10,000 shares trading cum div, but settling later. Depending on market rules, you might still be entitled on trade date. Shorts add complexity. A short position through record date may create a manufactured dividend obligation. To put this in perspective, short 5,000 shares and a 0.80 dividend can mean you owe $4,000. Interview-ready line. I assess net eligible position, settlement status, and any borrow loan impacts. Corporate actions on loan securities are a common break driver. If you lend shares over record date, the lender may lose the entitlement unless there's a recall or compensation mechanism. For example, you lend 100,000 shares and a 25-cent dividend occurs. $25,000 must be compensated via a manufactured payment. Reclaims happen when the manufactured payment is wrong and the lender disputes it. To put this in perspective, mismatched tax rates or incorrect share quantities can cause months-long claims. A strong interview answer: I track loan status, recall timelines, and ensure the correct entitlement is applied to lender versus borrower. Dividend processing is rarely just rate times shares. You must know gross versus net and withholding rates. For example, a $1 dividend with 30% withholding pays 70 cents net. On 12,000 shares, gross is $12,000 and net is $8,400. Documentation like tax forms or residency status can reduce withholding, so ops needs accurate account setup. To put this in perspective, a 15% rate versus 30% rate on a $100,000 dividend is a $15,000 difference. Interview phrasing: I confirm tax status, apply the correct rate, reconcile gross to net, and ensure reporting aligns to the client statement. Expect scenario questions with minimal data and high pressure. Corporate actions are a lifecycle discipline. Step 1: announcement, ingestion, and validation. Step 2: eligibility and entitlements. Step 3: elections and instruction transmission for voluntary events. Step 4: pay date booking, cash and securities movements. Step 5: Reconciliation against agent custodian statements. For example, if you expect $50,000 cash from a dividend but receive $49,500, you investigate a $500 variance, often tax, fees, or position mismatch. To put this in perspective, strong teams run daily exception reports and chase differences within 24 to 48 hours. Interview signal. I think end to end, not just one date. Avoid vague answers like, "it depends," without a rule. Instead, state the default rule, then list the checks. For now, you understand event classification and date-driven entitlements. But there's one thing that can undo this progress: how firms control breaks, exceptions, and fails when reality doesn't match the announcement. Make sure you don't miss our next breakdown. Subscribe and hit the bell so you never miss an insight from this channel. Drop in the comments, what corporate action scenario trips you up most? Ex-date, proration, or elections?